Hi everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, thanks for tuning in to our latest market update and outlook video. I don't know if you're like me, but I'm feeling a little overwhelmed every time I turn on the TV and I turn on the news. There's a lot of heated debates, a lot of drama, what's going on with the tariffs. Now, we don't know exactly where this is all going to end up, but I want to show you exactly where the economy is right now. And I also want to show you some of the leading indicators of what's going on with the economy as it pertains to the two most important things to the stock market right now. And that's what's going on with inflation and what's going on with growth. So let's get right into it. All right, let's get started with the asset class returns for the month of February. So when you look at the domestic stock market here in the dark blue for February, it was a pretty lousy month. We actually had a pretty good start in January, but we lost all of that from the month of February and potentially a little bit more as it spills over into March. But it was really led by small caps. I mean, the large caps, as you can see, were down as well, especially large cap tech. There's, again, some spillover from DeepSeek and the stuff that started in January. But this month, we're going to be talking a lot more about it, but there's basically some concerns about growth, and that's really been hitting the small cap stocks the hardest. And that goes along with tariffs and stagflation, which we're going to get more into. But interestingly, it hasn't been the story for all of the market, which is why it's so important to have a diversification, right? So we have real estate that's up nicely, and look at international, up very nicely, again, beating the U.S. stock market. Not a lot of people would have guessed that going into the year, that international would be leading. And so we'll get a little bit into that, and probably more into that over the next few months. Fixed income has done pretty well. Yields have been coming down. That makes the value of the bonds go up. And so that's good because that helps, interest rates a little lower. That might help the economy a little bit. But it's been good for the bond market. And commodities have been kind of flat here this month, but had a pretty good start, especially with some of the oil and the metals that went up. As we were anticipating maybe some of the global economy would start doing a little better. Now we're starting to maybe second guess that a little bit, as you can see here. But let's get into what has been the catalyst to some of these big moves here recently and some of my thoughts here for going forward. All right, and before I get too much into the hot topics of the month, let me give you a quick recap of how the economy is doing and hit some of the main points that are important to always be on the front of your mind as we look at the health of the economy, which relates to the stock market, right? So the first big thing is the inflation update. I've been talking about this for years, it feels like now, but it's very important to look at this. The PCE, the Personal Consumption Expenditures Inflation Index, came out here about 2 weeks ago, and it was up 0.3 month over month. Now, that's not too bad. That was right in line with expectations. Now bringing the year-over-year number at 2.6%, which is actually down from about 2.9%. So inflation is still a little high, but it doesn't seem to be getting worse, and it seems to be in pretty good check. So that should be really good news for the Fed, because they want to see inflation get a little closer to 2%. And as they see that, they're going to probably be more comfortable to cut rates. And remember, when they cut rates, that makes everything a little cheaper, and the stock market really likes that. All right, and then I like to call it the Big Three report. That's the ISM manufacturing that came out actually earlier this week. And it was at 50.3. Remember, anything over 50 means it's growing. And so the fact now that we've had 2 months in a row of manufacturing growth is actually a really good sign, because we haven't had a lot of manufacturing growth in many years. And so this is actually a pretty positive sign for the economy. ISM Services PMI, this is the cousin that relates to services. Now, services is even more important. That's 70% of our economy. That's showing at a 53.5. So that's up from last month as well. So that's a pretty decent number there showing again above 50 of pretty good growth. So that was a little higher actually than expected. And today is Friday. I'm recording on the 7th. We had the jobs number that came out. The expectation was for 170 and a 4% unemployment rate. It was 151 and a 4.1% unemployment rate. So it wasn't quite as good as the expectations, but pretty darn close. I don't know. I think that would be maybe splitting hairs to say that it was a bad report. So we basically are looking at a pretty decent economy that shows decent growth. Unemployment is not getting out of hand, still shows pretty low unemployment rate and still decent job growth. All right, so let's talk about the topic du jour, and that's about tariffs. And so I could probably make a whole video about this, but frankly, it's a little controversial, all right? And it's changing daily, so depending on when you're watching this, this information could already be dramatically different. But here's what's happened so far. All right, we have a 25% tariff that's going into effect on Canada and Mexico. Now they keep making exceptions. They keep pushing it out. In fact, right before I came on, I saw that they're pushing this out again till April for the most part. For since we're all part of the USMCA, which is an agreement that was done back in 2018, which basically includes most things. So basically, there's no tariffs really on Canada and Mexico until April. And we do have the tariffs also for China. Those appear to have very to no exemptions, and they're definitely going into effect as of now. And so that's a 20% tariff on China. All right. So the other thing that's coming up, and this is why you have to kind of think ahead a little bit, because in April 2nd there could be reciprocal tariffs that will be added. I probably shouldn't say there could be. There probably will be. In fact, I just heard the president talk about that this morning, saying they could be added tomorrow. It would be hard to see that happen unless something dramatic happened, but most likely it's going to be in about a month. And so if you want to get a little bit more into the tariff conversation, look at my video from last month as far as is this a negotiation tactic? Is this for real? It's probably a combination of both. And so especially with our friends, it does look like it's being used more as a negotiation tactic, especially for handling the border and fentanyl and things like that. For China and for these reciprocal tariffs, I think it's trying to, first of all, with China is a little bit of the fentanyl as well, but it's also trying to deal with just being a little bit more fair to the United States, and maybe a little protectionism for certain kinds of industries that we want to make sure we preserve, and maybe bring some jobs back. But the problem here that we run into with tariffs, which I'm sure you've heard of before, is they could potentially be inflationary. Somebody has to pay the tariffs. Now, it could be a combination of the seller and the buyer, and it could be a combination of the currencies being devalued in other countries to make them a little bit cheaper here. All those things are kind of hard to figure out exactly how it's going to affect. So right now, what I can say with this is we don't know exactly what the tariffs will be long term. We don't know exactly what the ramifications of the tariffs are going to be and how it's going to affect earnings. And so right now there's a lot of questions. The market's having a little indigestion about this because the market, what it hates the most is uncertainty. Just tell us exactly what's going to happen and we start to figure out ways around it, good or bad. The market just wants a little bit more certainty. And right now there's not a lot of that as far as tariffs go. All right, so in the market outlook, I want to explain to you what this all boils down to, this conversation about tariffs and potentially inflation. Now, the reason this is a big deal is because it does appear like maybe things are slowing down a little bit. And if we start getting a little inflation on top of that, we could get something that we don't see very often that's called stagflation. Okay, this is when you have inflation getting worse, unemployment starting to pick up, and an economy that's starting to go down. It's very rare and it's very difficult to deal with because the Fed doesn't really have any good tools to help lower inflation and also make the economy better. There's no such thing as that. All they can really do is change the interest rates. And so when they lower interest rates, it helps the economy, but it can make actually inflation get worse. And if they raise interest rates, it can make inflation get better, but it can make the economy get worse. And so they don't have a good tool. This is why stagflation is very dangerous, and which is why you're seeing the market get a little nervous about this. So let's dig into a little bit into each one of these facets. All right, so let's talk first about inflation. Now, I showed you where the inflation numbers were in the update, but that just kind of shows you a snapshot of where we are versus where we were a year ago. What is the look forward on this? Now, the best things that I think you could do is look at the Fed funds futures. This is what the betting market thinks the Fed is going to do with interest rates over the next year. And so this chart here is a little wonky, so I won't get too much into it, but you could see that right now we're at 4.25 to 4.5 on interest rates. And the highest probability by the end of the year is for us to be at 3.5 to 3.75. So you're basically looking at almost a 1% cut in interest rates that's being priced into the markets. Now, when you look at just a month ago, we were only looking at about 1 or 2 cuts versus 3 to 4 cuts. So if there's inflation concerns, do you think that the Fed is going to be cutting rates more or less? Probably they're going to be cutting less. So the fact that they're going to be cutting more shows that they're not really so concerned about inflation, maybe a little bit more of a concern about growth. All right. And then on this side, I show you a chart of an index that follows commodity prices, all the different commodity prices, oil and agriculture and metals. And you can see here that right around February, there's been a pretty big drop in the commodity prices. Commodity prices directly feed into what's going on with inflation, right? And so with commodity prices going down, we're not seeing big concerns about inflation. The whole concern about inflation is a what if the tariffs make inflation go up. It could happen. We'll have to see. But this is still a big hypothetical. What we're seeing right now and what's being priced in for the future when you look at commodities and you look at the Fed funds rates is inflation continuing to go down. All right, so what about growth and the unemployment? Now, that's the part that I think the market is also concerned about. Two quick points to bring up here is you have the University of Michigan consumer sentiment. Again, this is sentiment. This is just how people feel. It's not what's really going on. It's just their thought process. And you could see that basically since the beginning of the year, sentiment has really dropped down pretty dramatically. And I can almost correlate that exactly with what's been going on with these tariff conversations. So the concern about what tariffs could do to the economy and to inflation is actually creating some of the growth concerns, which is kind of ironic, you know? It's like a self-fulfilling prophecy maybe in a way. And then you're also seeing over here on this chart, this is a chart that comes from the Federal Reserve of Atlanta. It's called the GDP Now, and it shows how basically the GDP numbers that are being anticipated for the rest of the year have just dropped down dramatically. We were running at about 3%. The consensus was around 2% or so, as you can see here in the blue. But boom, big drop in the Atlanta Fed GDP estimate. And that is being talked about a lot in the media. And I want to bring this up because what's going on here is last month in January, there were so many imports that were coming in because concerns that tariffs were going to be coming into place very soon, which they're probably right. So they had tons of imports that came in. And the way GDP is calculated, you take GDP, you take the growth of the economy, you add exports and you subtract imports to come up with the GDP. So I'm kind of wondering if maybe January is a little bit of an anomaly because there were so many more imports than normal. People trying to front run, what's going on with the tariffs. So February and March is probably going to look a little bit more normal. In fact, with a lot of inventory, they're probably not going to have to go out and buy as much stuff. And so it might that you'll see those GDP numbers spike probably a lot higher than they should be in the month of February and March. So I think that's being overblown a little bit. But there are concerns, and you saw that in the unemployment report that I talked about in the update. There's definitely some concerns where things are slowing down a little bit, but it appears like it's just a little slowdown, not this big giant drop. Alright, so here's the bottom line slide, the Heartwood implications. As you can see here, I'm showing a yellow light. So we're going a little bit more neutral with the portfolios. Last month we were a little bit more on the go. So we're kind of taking a little bit slower now. The market is having a little bit more indigestion with processing some of these tariffs than I thought. So we're going to start to slow down and go a little bit more conservative. And the big thing here is what I wrote here on this little subtitle. Sequencing for the policy priorities are a bad setup for the first half of the year. And it's because, the first 100 days, things are a little bit easier to get done as we go through the honeymoon stage. So I think they're trying to do the harder stuff first. Plus, the president has the ability to do the tariffs without Congress and without having to pass a lot of laws, and so that can take a little longer. So on the back end of the year, I do see hopefully Congress will start to get more into the deregulation and get into the tax cuts, which is going to be a lot more positive for the stock market. But in the meantime, we're going to see a little bit more indigestion, all right? And so what we're doing with the stocks, we're lowering the small caps just a little bit. We got in a little early on those. I still believe in the small caps as we have a little bit more of the reshoring that's going on here and just a lot more attractive valuations there in the small caps. But for right now, we're going to be trimming that back a little bit, adding a little bit more in the large cap quality. So as we see the coast gets a little clearer, we might reverse that. And then in the bonds, since the bond yields have come down a lot, we want to go ahead and start to remove some of the long-term bonds. Unless there's a recession, which I don't see in the cards right now, we're going to be trimming that back, going into more floating rate bonds that take advantage of better yields. And if yields go up, they won't get hurt as bad. And then just holding on a little bit more to cash as the cash is generated from dividends and interest, just kind of holding a little bit more, keeping it while we're getting good yields and waiting things out just a little bit. But believe me, we're not in a ton of cash, all right? We're being neutral overall in our allocation, and I do think that things are going to start to turn around a little later in the year, but we just got to be patient as we go through this processing time with the markets, and there's probably a little bit more to go, unfortunately. Thanks for watching, guys. I hope this helps. Please reach out if you have any questions. Please feel free to share this video with your friends and family. I would love that. And God bless. Bye-bye.